Out of the Finance Ministry's directive to channelize pension money into mutual funds, the mutual fund industry body, that's AMFI, has designed a pension scheme for mutual funds which has been submitted to the Finance Ministry. Mrinalini Krishna joins in with exclusive details. Mrinalini, what's the structure of this plan and what checks have been put in place considering this is pension money?
Well, Sandeep, what we are picking up from sources is that mutual fund industry body AMFI has submitted the design of a pension or retirement plan to the Finance Ministry. In fact, the checks and balances that they've put in place is that any equity diversified scheme that rules out any sectoral or thematic funds, any equity diversified scheme that has a 3-year track record, as well as a minimum average AUM of 300 crores over the last 3 years, will be eligible to have this pension plan structure. In fact, the investment of the investor will depend on his age limit. They can do an SIP into this scheme. However, once the investor attains the age of 55 years, the equity exposure will come down to 50%. Once the investor becomes 60 years, it will come down to 30%. And if the investor is 65 years, it will come down to 10%. And after 70 years of age is when the investor will have absolutely no equity exposure. Now, what we are also being given to understand is that there is a demand for tax benefits for these pension plans, to put them at par with other pension products that already have tax benefits. For example, there's a national pension system as well as the pension plans of insurance companies, but a clarity on what kind of tax benefits will be given to this scheme, and if there is going to be any modification to this pension plan structure, will only emerge with the budget this year.
Okay, Mrinalini, thanks as always for walking us through those exclusive details. Let's take the discussion forward. Dhirendra Kumar, CEO at Value Research, joins us now to analyze this bit of news. Dhirendra, how do you rate these planned changes, and are they likely to benefit both investors as well as equity markets?
Yeah, I think if it becomes a reality, if it happens, then this will be revolutionary, because historically we have never seen a mechanism in our equity markets, any vehicle which will channelize long-term savings into equities. And so that is why we see only opportunistic seasonal money coming into equity. Either it is good time for NFOs or IPOs, or there is drought. So in that sense, this will facilitate a mechanism where there will be consistent money flowing into the market. The money which comes in will not exit in a hurry. And so this will be great. This could be, if this happens, I think this will be one of the biggest reforms which we can think in terms of, which has the potential to transform our investments.
Dhirendra, what's your sense? Why do you think this plan will succeed at a time when investors otherwise seem to be pulling out of SIPs even as equity markets rise?
As I was saying that, mutual equity as an investment has always been looked as opportunistic. People invest in a hot IPO, people invest in a NFO, people invest at the wrong time, and investing in equity is never part of your savings plan. Here is the incentive mechanism. Here is the incentive which will, incentivize the individuals to invest regularly. And if at some stage, this pension plan becomes a discretionary pension plan, about 30-35 years ago, American equity market gained the depth when the 401k plan was introduced there. This is the equivalent of a 401k plan where investors have the choice. They save for their pension, they save for their retirement, but where to save is their choice. That is something which is today mandated by the law. If at some point we as employees of various companies or various employers, if we are given a choice that we can choose to put our money in employee provident fund, or we can choose our own pension plan, as long as we are making our investments in pension plan, we are getting the tax break. That is what we get today. The government, if just extends the choice, extends the liberty of making the choice ourselves, that will be revolutionary, and that is significantly different from the way we have seen equity being experienced by Indian investors.